This year, Nordic stocks have beaten the U.S., but it's not because the Nordics suddenly have better companies. It's due to three structural differences between the Nordics and the U.S. that the market often underestimates. Mark, can you enlighten us all about this?
When I say the Nordics, I mean Sweden, Denmark, Norway, and Finland. Four small markets, very different from each other. That's important, because the Nordics are not one single market, and they didn't outperform the U.S. for the same reasons. Before we look at the reasons, we need to compare markets correctly. Here, I'm looking at equity performance in local currency. That way, we separate stock market performance from currency effects. Otherwise, it's easy to draw the wrong conclusions. The first reason is market structure. The U.S. stock market is heavily dominated by technology companies, growth stocks, and a small number of very large firms. This creates concentration. When sentiment is strong, that concentration helps performance. But it also increases sensitivity. If expectations change, market performance can shift very quickly. The Nordic markets look very different. They are more exposed to industrial companies, banks, healthcare, and energy. These sectors tend to benefit when interest rates stop rising and inflation stabilizes. In other words, the Nordics were structurally better positioned for this type of market environment. The second reason is valuation. Valuation is not about predicting the future. It's about understanding expectations. At the start of the year, U.S. equities were already expensive by historical standards. That meant the market needed very strong news to justify higher prices. Nordic markets entered the year at much lower valuations. That doesn't mean the companies were better. It means expectations were lower. When expectations are low, even modest positive surprises can lead to strong returns. This is often called multiple expansion, and it played a key role in Nordic market performance this year. The third reason is currency, and this is where many investors get confused. Over the past few years, Nordic currencies were very weak against the US dollar. This year, currencies like the Swedish and Norwegian krona strengthened. That creates a double effect. For Nordic investors, domestic equity returns look stronger. At the same time, U.S. investments look weaker once currency is taken into account. Currency doesn't feel important until it suddenly becomes very important. This doesn't mean the Nordics will always outperform the U.S. Market leadership is cyclical. If interest rates fall sharply and growth becomes the dominant theme again, U.S. equities may regain the advantage. But if rates remain higher for longer and valuations continue to matter, Nordic markets may stay relatively strong, and currency will remain a key variable. Nordic markets performed well this year, not because of headlines, but because of structure, valuation, and currency. Understanding those drivers matters far more than reacting to short-term news. More analysis on Nordic markets coming every week.